Welcome back, everyone. Today, we are tackling one of the most exciting and time sensitive opportunities in retirement planning, the 2025 Mega Backdoor Roth setup deadline. If you are self employed or running your own business, this could be your last chance to unlock tens of thousands of dollars in tax free retirement growth. But here's the thing, miss the deadline and you may lose this year's window entirely. So stick around because in just a few minutes, we'll show you exactly what the deadline means, who qualifies, and how to avoid costly mistakes. So today's topic is the year 2025 Mega Backdoor Roth setup deadline. As always, we use these daily webinars to not only cover certain topics, but we also answer your questions live on the air. That being said, go ahead and type over your questions, which can be regarding any topic about retirement accounts. In other words, it doesn't have to be based on today's webinar topic, which is the year 2025 Mega Backdoor Roth setup deadline. Please also subscribe to our YouTube channel to help get the word out to other solopreneurs like yourself. You can also, if you can also like today's webinar, that would be great. We go live every day, typically once a day, sometimes a couple times a day. For example, we'll be going live again here in a few hours. So if you subscribe to our YouTube channel, you will receive notifications regarding when we go live. Also on our YouTube channel, we have a large video catalog covering all aspects regarding retirement accounts. You can also join our My community, which is free to join. We have over 30,000 members there. So if you are a financial professional, whether a CPA, tax advisor, financial advisor, insurance agent, real estate broker, agent, and so forth, you can also join for free and post guest blog posts so that you can flex your knowledge to our 30,000 plus members. And you can even link back to your company's website so that the members can read more about your services if they're interested. Also, take a look at our artificial intelligence page, which is www.solo401k.ai. So again, go ahead and type over questions you have during today's daily webinar, and we're going to answer those questions as they come in. So let's talk about what we're going to cover today. So we're going to talk about the critical 2025 setup deadline for Mega Backdoor Roth. We're going to talk about how much you can actually contribute. Hint, it's way beyond the standard annual limit, which is $23,500 for tax year 2025, for example. We're going to talk about why Secure Act 2.0 makes the timing even more important. And we're going to talk about a step-by-step process you'll need to follow to get your solo 401k structured properly before the clock runs out. All right, looks like we have a question here. Let's take a look at that. Is the after-tax Roth contribution required to have a gross salary minimum of $70,000? Good question. We're going to be covering that example here today. But in short, if we're referring to tax year 2025 contributions, the overall contribution limit for tax year 2025 is $70,000. The IRS has not yet released the annual contribution limits for tax year 2026, but they generally release it around this time. by October at the latest. So we're going to know soon what the year 2026 contribution amounts are. But back to your question here, if your self-employed business is an S corporation and you pay yourself W-2 wages from that S corporation because you are an owner employee of that business, and if we're referring to tax year 2025 contributions, then yes, you're going to need to pay yourself a minimum of $70,000 of gross W-2 wages so that you can contribute that entire $70,000 to the voluntary after-tax solo 401k bucket and then convert it either to the Roth solo 401k or the Roth IRA, resulting in the mega backdoor Roth strategy. So a good question, and we'll be talking about that in more detail. Looks like we have another question here. I think I understand that for the mega backdoor Roth, I can contribute after-tax dollars to my solo 401k and then basically move all of that to an existing Roth IRA. Does not need to be moved to a Roth account within the solo 401k, correct? You're exactly right. When you the mega, but that's what's so intriguing about the mega backdoor Roth, aka mega backdoor Roth solo 401k strategy. That is, you can A, choose to solely make voluntary after-tax solo 401k contributions up to the overall limit, and B, you can choose to convert that voluntary after-tax solo 401k contribution to the Roth solo 401k, or you can convert it to a Roth IRA instead. For example, if you look at the slide here on the left here, that is an example of a one participant plan. In other words, this person is self-employed. It's just the individual. If he or she were married, then the right in the slide on the right, which is a two participant plan, then the dynamics would change. But if we're referring to a one participant solo 401k plan, then the individual would have separate holding accounts under that solo 401k plan to hold their respective solo 401k sources. So looking at the slide on the left for a one participant plan, you would have three separate brokerage accounts under that solo 401k plan, or it can be bank accounts, the AKA holding accounts. So one plan, three separate holding accounts. The individual would make the voluntary after-tax solo 401k contribution to this bucket here, the voluntary after-tax solo 401k bucket. And then he or she would convert it to the Roth solo 401k bucket. But in your case, regarding your question, instead of you converting it to the Roth solo 401k bucket, you would convert it to a Roth IRA. So you can convert it to an existing Roth IRA you may have, or if you don't have a Roth IRA, you would open up a new Roth IRA and convert the voluntary after-tax solo 401k contribution to the Roth IRA instead of the Roth solo 401k bucket. So a good question on that. Okay, go ahead and continue to type over your good questions, and we'll pause and answer those questions as they come in. In the meantime, please go ahead and like today's videos to help us get the word out to other solopreneurs out there. And also subscribe to our YouTube channel so that you know when we go live, as we'll send you a notification. So the business setup matters. So what that means is that you want to make sure that you're self-employed in the year that you open the solo 401k plan. So for example, here in tax year 2026, excuse me, here in tax year 2025, if you want to be able to make voluntary after-tax solo 401k contributions to your solo 401k as part of the mega backdoor Roth strategy, you're going to want to make sure that you are self-employed here in tax year 2025, because we're going to talk about how you can make contributions as part of the mega backdoor Roth strategy all the way up until your business tax return due date plus timely filed extension. So therefore, if you open the solo 401k plan here in 2025, you're going to be able to make contributions to that solo 401k plan in tax year 2026 for tax year 2025. And we're going to delve deeper into that. So you want to make sure that you are self-employed here in 2025. Don't wait until 2026 to be self-employed. Because if you wait until tax year 2026 to be self-employed, it's going to be too late to make contributions for tax year 2025 and 2026 by your business tax return due date plus time you filed extension. So you want to make sure you are self-employed here in 2025. And self-employed, you can be self-employed under a sole proprietorship, under a formal entity such as an LLC or an S corporation. But the key is that you perform self-employment activity in tax year 2025 if you want to be able to make tax year 2025 contributions in tax year 2025 or in tax year 2026 for tax year 2025 by your business tax return due date plus timely filed extension. If you don't, then you're going to miss out on thousands of dollars of voluntary after-tax contributions to that solo 401k, which then get converted to the Roth solo 401k or the Roth IRA, and thus it's dubbed the Mega Backdoor Roth strategy. So again, you want to make sure you get that you do that self-employment activity in 2025. If you're a sole proprietorship, you don't have to register your business with the IRS or your local Secretary of State in your state of residence. You just need to make sure that you perform those material services and that you report that earned income from self-employment activity on a Schedule C for tax year 2025. Likewise, if your business is taxed as an S corporation, you want to make sure that you perform, well, number one, that you set up that S corporation in 2025. So you'll have to register it. You'll have to also elect S Corp status with the IRS. And you'll want to make sure that you do work in 2025 so that you have the necessary W-2 wages by the end of tax year 2025 so that you can make contributions for tax year 2025 and 2026 by your business tax return due date plus timely filed extension. So that's important. I think my slides got kind of mixed up here. As far as the order. So the critical setup deadline for the Mega Backdoor Roth. Again, we already talked about how the critical deadline is that you need to make sure that you perform self-employment activity in tax year 2025. As far as the actual setup deadline of the solo 401k plan, you actually have quite leadway to do that. Because with the solo 401k plan, and again, we're talking about the Mega Backdoor Roth strategy setup deadline for tax year 2025. So technically, you don't have to open up this solo 401k plan here in tax year 2025 in order to make year 2025 Mega Backdoor Roth contributions in 2026. But again, you do need to make sure that you perform that self-employment activity in tax year 2025 by December 31st of tax year 2025. So assuming you're self-employed in 2025, that means that the setup deadline for your solo 401k, if your goal is to solely utilize the Mega Backdoor Roth strategy, which means you solely plan to make voluntary after-tax solo 401k contributions, because that's the first step in the Mega Backdoor Roth strategy is making that voluntary after-tax solo 401k contribution through that solo 401k bucket, that voluntary after-tax bucket. So this bucket right here. So that's the first step, is having the earned income from self-employment activity in 2025 so that you can make that voluntary after-tax solo 401k contribution, which is part of the mega backdoor Roth strategy. Once you make that voluntary after-tax contribution, then you convert it to the Roth solo 401k or the Roth IRA. So again, you're going to be able to open up the solo 401k plan in tax year 2026. So you don't have to open it here in 2025. That's probably a good idea that you do if you have time, and you still have time. We're not approaching the end of the year for a few months, so you still have plenty of time to open it in 2025. But technically, you don't have to open that solo 401k plan in tax year 2025 so that you can utilize the mega backdoor Roth strategy. You actually have, and it's going to be driven by your self-employed entity type with respect as to when you need to open up the solo 401k so that you can utilize the year 2025 mega backdoor Roth strategy. So for example, if your business is a sole proprietorship or even an LLC tax as a sole proprietorship, you have until April 15 of 2026 to open the solo 401k plan so that you can make voluntary after-tax solo 401k contributions for tax year 2025 and also perform the mega backdoor Roth strategy in 2026. So now, if you file a business tax return extension and you're a sole proprietorship, you're going to have all the way up until October 15 of 2026 to open the solo 401k plan so that it's effective for tax year 2025 so that you can make voluntary after-tax solo 401k contributions for tax year 2025 and then turn around and convert it to the Roth solo 401k or the Roth IRA. Now, if your self-employed business is a partnership or an LLC tax as a partnership, then the 2025 year mega backdoor Roth setup deadline is going to be March 16 of 2026. And if you file a tax return extension for that partnership, you're going to have until September 15 of 2026 to open the solo 401k and make that voluntary after-tax contribution for tax year 2025. And you have Secure Act 2.0 to thank for all these changes. Secure Act 2.0 has essentially changed the solo 401k setup deadline, but it didn't change it for all contribution types. But again, today's webinar is regarding the mega backdoor Roth strategy setup deadline for 2025. In future webinars, we'll cover the solo 401k setup deadline for tax year 2025 if you want to make employee contributions and employer contributions. This relates solely to making voluntary after-tax solo 401k contributions as part of the mega backdoor Roth strategy. Now, if your self-employed business is taxed as an S corporation, or if it's an LLC taxed as an S corporation, then the tax year 2025 solo 401k setup deadline for the mega backdoor Roth strategy is going to be March 16 of 2026. If you file a business tax return extension for 2025, it's going to be September 15 of year 2026. If it's a C corporation, it's going to be April 15 of 2026 with regards to the mega backdoor Roth setup deadline for tax year 2025. If you file a tax return for your C corporation, an extension that is, a business tax return extension for that C corporation, then you're going to have until October 15 of 2026 regarding the mega backdoor Roth setup deadline. So the mega backdoor Roth setup deadline extends all the way up until 2026 for those that want to make contributions for tax year 2025 as part of the mega backdoor Roth strategy. It extends all the way up until the business tax return due date plus the business tax return due date timely extension deadline. So that's pretty lenient. So in short, you have plenty of time to meet the year 2025 mega backdoor Roth setup deadline, but you need to make sure that you are self-employed in tax year 2025. So that's a little bit different. You got to make sure that you're doing self-employment activity because you got to have enough earned income from your self-employment activity by December 31st of tax year 2025, so that then you can wait till the year 2026 to open that solo 401k plan so that you can make year 2025 make a backdoor Roth solo 401k contributions. All right, I know that's a lot to throw at you. Again, this video is being recorded. We're going to post it on our YouTube library where you can view over 900 videos that we've done on several topics, or many topics for that matter. So that's why it's important to understand the setup deadline. Let's see here if we have any other questions for now. So we have a question from Eddie. As a sole proprietor, can the solo 401k be opened on a SSN, or would I need to apply for the EIN? So if so, is that a fairly straightforward, quick process? Great question. So the solo 401k plan is a retirement trust. So it's required to have its own separate EIN number. And if you utilize my solo 401k financial for the solo 401k plan, and they do offer the mega backdoor Roth strategy, then my solo 401k financial will obtain that EIN number for the solo 401k, which is a retirement trust, and that can typically be done in one day. And again, that is required as part of the self-directed solo 401k setup regulations, and it's going to be utilized when the solo 401k brokerage account is opened, or the bank account for the solo 401k plan. Because remember, the solo 401k plan is a defined contribution 401k, which means that you're required to have separate buckets, aka bank accounts or brokerage accounts, for that solo 401k plan. So it's just one plan with separate brokerage accounts. So that same EIN number is going to be used for each separate brokerage account. Likewise, if you have a two-participant plan where, let's say, you and your spouse are both self-employed in the same business, let's say you're both employed under the same LLC, so the LLC sponsors the solo 401k plan, and each spouse is going to have separate holding accounts, aka bank or brokerage accounts, under that solo 401k plan to hold their separate solo 401k fund sources. So one to hold the pre-tax solo 401k funds, a second to hold the Roth solo 401k funds, and a third bucket to hold the voluntary after-tax solo 401k funds. So a total of 6 separate brokerage accounts if we're talking about a two-participant plan. So one plan, 2 spouses, 6 separate brokerage accounts for each source. So a total of 6, 1 for each spouse. Same EIN number because it's one plan. So each brokerage account will have the same EIN number used. So yes, the EIN numbers for the solo 401k, which is also known as a retirement trust. It's a separate legal entity, hence why an EIN number is required. It's also going to be required when you perform the mega backdoor Roth strategy, because the mega backdoor Roth strategy requires the issuance of both a Form 1099-R and a Form 1096 to the IRS to report that mega backdoor Roth conversion, and the EIN number for the solo 401k is going to be used. So that's very important. So good question. Here's another good question. We get this question quite a bit, actually. How long should we wait between making voluntary after tax and converting to a Roth IRA? Great question. I know about 3-4 years ago, there was a lot of noise on the internet where even some financial professionals and even well-renowned financial professionals would say, hey, you should not convert those voluntary after-tax contributions right away because it could be a red flag by the IRS. And I saw that being said mainly when individuals were performing the backdoor Roth IRA, and it started to bleed into the mega backdoor Roth. But now the consensus in the industry, and even some of those individuals that were saying before to wait to convert that voluntary after-tax contribution, now they're saying the same thing, that no, you want to convert those funds right away. You don't want to let those funds sit in that voluntary after-tax bucket, because they're going to be accruing earnings. So typically, you do not want to invest those voluntary after-tax solo 401k contributions, because if, let's say, you invest them in some type of stock or index fund, and there's large growth, and when you convert that voluntary after-tax bucket, you have to move all the funds out of that voluntary after-tax bucket. It's got to be emptied out. So when you convert all those funds over to the Roth IRA or the Roth Solo 401k, and if there are any gains, you're going to have to pay taxes on those gains. So it's best to not invest those voluntary after-tax solo 401k contributions. And second, it's best to convert them right away so that there are limited gains. So no, you don't want to wait. You want to convert them right away. As soon as those funds are ready to be converted, you want to convert them right away. So good question. Okay, go ahead and continue to type over your questions during today's daily webinar. So in the meantime, let's get back to our topic today, which is the year 2025 Mega Backdoor Roth setup deadline. We already talked about the deadline for each self-employed entity type. Let's take a look at some more information here on these slides here. So let's see here. Roth conversions. We've been talking about that, but let's talk about that a little bit more. So keep in mind that when you make a voluntary after-tax solo 401k contribution, you need to convert that to the Roth Solo 401k or the Roth IRA. And you typically want to do it right away, as I mentioned, so that there are no gains. What is more, here's an important distinction to understand. So you've got the contribution rules, and then you've got the conversion rules. So again, we're talking about the year 2025 Mega Backdoor Roth setup deadline. So let's use the S Corporation example again. We talked about how the deadline for the Mega Backdoor Roth strategy for tax year 2025 for an S Corporation is March 16 of 2026, or it can be September 15 of 2026 if you file a business tax return extension. So that means that you don't have to open that solo 401k plan in tax year 2025. You can wait and open it in tax year 2026 by the business tax return due date plus timely filed extension. So if you wait to do it next year in 2026, and you also make the contribution in 2026 by the deadline, then the contribution deadline will have been met. Now, as far as the conversion regulations, those are a little bit different. So conversion rules is when you actually convert that voluntary after-tax solo 401k contribution to the Roth solo 401k or the Roth IRA. So if you make that voluntary after-tax solo 401k contribution to the voluntary after-tax solo 401k bucket, aka holding account, and if you make that by March 16 of 2026, because your business is taxed as an S corporation, then you turn around and process that conversion in 2026. Well, the contribution is going to count for tax year 2025. However, the conversion is going to count for tax year 2026. And that's because conversions are always treated as being converted in the year that you actually move the funds from the voluntary after-tax solo 401k bucket to the Roth solo 401k bucket or to the Roth IRA, which means that you're going to receive a Form 1099-R for tax year 2026, and you will receive that in January, February of 2027. Now, before you start scratching your head or panicking, it doesn't really matter. Why? Because when you convert voluntary after-tax solo 401k funds, it's not a taxable event nor did you get any credit, nor did you get a tax deduction for making that voluntary after-tax contribution, because voluntary after-tax contributions do not reduce your taxable income for the year. Excuse me. Excuse me. So when you make that, when you convert those voluntary after-tax solo 401k funds, whether you convert them in 2025 or whether you convert them in tax year 2026 from the voluntary after-tax solo 401k bucket to the Roth, or the Roth to the Roth solo 401k or the Roth IRA, yes, the Form 1099-R may not be issued till the following year if you convert in 2026, whereas if you convert in 2025, you'll get that 1099-R in January, February of 2026, and it'll count as a conversion occurred in 2025. Well, it doesn't matter, because you're still going to be able to do another mega backdoor Roth strategy for tax year 2026 when you make a tax year 2026 contribution. So don't mix up those regulations. We get a lot of questions actually come tax season. Clients will ask, I did receive a 1099-R for the conversion that I processed in 2025, even though I'm now in 2026. Well, that's because you didn't actually convert the funds. You didn't actually move the funds from the voluntary after-tax solo 401k bucket to the Roth solo 401k bucket until 2026, even though it counted as a year 2025 contribution. But that's not going to preclude you from doing another mega backdoor Roth strategy for tax year 2026. Okay, so a good question. Let's continue here, and we'll come back and look at some more questions. Let's take a look at some more slides here. Give me a moment here while I pull those up here. So let's kind of talk about understanding solo 401k contributions. So most individuals think that contributions to a solo 401k are only made up of employee deferrals and employer profit sharing contributions. Well, there's the third bucket, which is voluntary after-tax solo 401k contributions as part of the mega backdoor Roth strategy. So with the mega backdoor Roth strategy, you gotta make sure you open a solo 401k plan with a provider such as my solo 401k financial, who provides a plan that allows for voluntary after-tax contributions and plan conversions. And as a result, the mega backdoor Roth strategy, not all providers allow for it. For example, typical providers like Fidelity, Schwab's of the world, they do not allow for it. But they do provide brokerage accounts for a solo 401k plan offered by my solo 401k financial that allows for the mega backdoor Roth strategy. And with the mega backdoor Roth strategy, as I mentioned earlier, you can choose to make the entire overall contribution to the voluntary after-tax solo 401k bucket and forego making employee and employer contributions. Because the mega backdoor Roth strategy, when you utilize the voluntary after-tax solo 401k bucket, it's a dollar for dollar calculation. And we'll talk about that more in a moment. So keep that in mind. So if you're a high income earner, you may want to contribute the full overall contribution amount for tax year 2025, for example, which is $70,000. That's the overall contribution. You may want to contribute that entire $70,000. Of course, you got to have enough net self-employment income in order to contribute the full 70,000 overall limit. But you have the option of solely making voluntary after-tax solo 401k contributions up to the overall limit of $70,000. Of course, you won't be able to make any other contributions. You won't be able to make employee or employer contributions, with the caveat of if you're age 50 or older, you would be able to make catch-up contributions, but those could not be deposited to the voluntary after-tax bucket. Those have to go to the employee pre-tax bucket or the employee Roth bucket. And that's for tax year 2025. Not to get off track, but starting in tax year 2026, the IRS changed the regulations. If you make catch-up contributions, those are going to have to be deposited to the Roth solo 401k bucket. You will no longer be able to contribute those to the pre-tax solo 401k bucket. I know I'm throwing a lot at you here, but we're talking about catch-up contributions, which are contributions that you can make if you're age 50 or older that you can make above the annual limit. So for tax year 2025, for example, the overall contribution limit for someone who's under age 50 is $70,000. But if you're age 50 or older, you can contribute an additional $7,500 as a catch-up contribution. So you can treat that as a pre-tax contribution, that catch-up contribution, or you can deposit it to the Roth solo 401k bucket if we're talking about tax year 2025. It cannot be deposited to the voluntary after-tax solo 401k bucket because the voluntary after-tax solo 401k bucket only allows for the overall contribution amount, which is $70,000 for tax year 2025. The IRS has not yet released the year 2026 contribution limits, but as I mentioned earlier, they'll probably do sometime this month or sometime in October. Now, there's the super catch-up contribution for those who are age 50 or who are age 60, 61, 62, or 63. So if you fall within that age category, you can do an additional super catch-up contribution of $11,250 instead of that $7,500 catch-up amount. But it's only available to that age group. So that would get deposited to the pre-tax bucket or to the Roth solo 401k bucket, but not the voluntary after-tax solo 401k bucket because the rules don't allow for it. Which is a moot point because the mega backdoor Roth strategy, the purpose of it is to get funds into your Roth solo 401k bucket anyways. So you can just make that super catch-up contribution directly to that Roth solo 401k bucket. And again, starting January 1st of 2026, you will no longer be able to make those catch-up contributions effective for plan year 2026 and going forward. You can no longer make those catch-up contributions to the Roth solo 401k bucket. Excuse me, to the pre-tax solo 401k bucket. You're going to have to make them to the Roth solo 401k bucket. So that's a new regulation, and that applies to full-time traditional 401k plans as well. So across the board to all 401k plans, not just solo 401k plans. So in review, effective for plan year 2026, catch-up contributions can no longer be applied as pre-tax solo 401k contributions. They have to be applied as Roth solo 401k contributions. So obviously those that want to treat them as pre-tax contributions, they do so because they want to reduce their taxable income for the year. Well, unfortunately, the Department of the Treasury, IRS, has changed the regulations, and now effective for plan year 2026, starting January 1st of 2026 and going forward, you're going to have to make those catch-up contributions, whether it's the normal catch-up or the super catch-up, will have to be deposited to the Roth solo 401k bucket. Okay, so let's take a look at some more information here. So we just talked about maximizing the mega backdoor strategy. I oftentimes get the question about making just Roth solo 401k contributions and foregoing making voluntary after-tax solo 401k contributions as part of the mega backdoor Roth strategy. Now, Secure Act 2.0 changed a lot of regulations as they pertain to not only defined contribution plans like 401k plans and solo 401k plans, but other types of retirement accounts. One of the big changes under Secure Act 2.0 is that now you can make employer Roth solo 401k contributions. You've been able to make employee Roth solo 401k contributions for a while, but now instead of treating those employer contributions as pre-tax contributions, now you can treat those as employer Roth solo 401k contributions. So if you decide to make solely employee Roth solo 401k contributions, as well as employer Roth solo 401k contributions, those would get deposited to the Roth solo 401k bucket holding account under the solo 401k. Now, we've done a webinar on employer Roth solo 401k contributions in the past. So again, take a look at our video catalog and you can find that specific video. Well, let's talk about it a little bit more. So when you make employee Roth contributions to the solo 401k, that's calculated on a dollar for dollar basis. So for example, if your self-employed business is taxed as an S corporation, you just need to pay yourself a maximum of $23,500 for tax year 2025 if you solely want to make employee Roth solo 401k contributions. You wouldn't be able to make any other contributions because you only paid yourself $23,500 of W-2 wages from your self-employed business. But the employee contribution calculation, whether it's a pre-tax employee contribution or a Roth employee contribution, that's a dollar for dollar calculation. Now, with employer contributions, also known as profit sharing contributions, those are calculated on a percentage basis. So it's not a dollar for dollar calculation. So let's say your self-employed business is an S corporation. Let's further assume you pay yourself $100,000 of W-2 wages. Let's further assume we're talking about tax year 2025. So that means that since we're talking about the year 2025 Mega Backdoor Roth solo 401k setup deadline, that means that if your self-employed business is an S corporation, so which means you're self-employed here in 2025, you report a total of $100,000 of W-2 wages from your S corp for tax year 2025. That means that you can make an employer contribution of 25% of that $100,000. So 25% of that is $25,000. And instead of treating that employer contribution as a pre-tax employer profit sharing contribution, you can treat it as an employer profit sharing Roth solo 401k contribution. Don't get too excited yet though, because even though it's going to go into the plan as a Roth profit sharing contribution, and the business is going to get a deduction for that contribution on the Form 1120S. I forget the line number. However, you're going to have to treat it as a taxable and planned conversion. So that $25, that $25,000 that was made to that solo 401k as an employer Roth solo 401k contribution, that's going to be a deduction on the employer side, which yes, it does reduce the FICA tax, the self-employment tax, the FICA tax on that, or the payroll tax, I should say. So it is going to reduce the payroll tax on the S corporation side. However, you're going to have to treat it on the personal side as a taxable and planned conversion. So now if 1099-R is going to have to be issued to report that as a taxable and planned conversion, and then you're going to have to report that as taxable income on your Form 1040, specifically on Schedule 1, which is an attachment to that Form 1040. Now, with the Mega Backdoor Roth strategy, that's made up of voluntary after-tax solo 401k contributions. That there is a dollar for dollar calculation, so it's not percentage based. So using my $100,000 example, where we illustrated that if you make it as an employer Roth solo 401k contribution, you can only contribute 25% of that 100,000. Whereas with the voluntary after-tax calculation, it's a dollar for dollar calculation. So you would not even have to pay yourself $100,000 if you're trying to contribute just $25,000. You would just need to pay yourself $25,000 and contribute that entire $25,000 of the voluntary after-tax solo 401k contribution, and then convert it to the Roth solo 401k or the Roth IRA, because it's a dollar for dollar calculation. It's not percentage based. Now, if you want to be able to contribute the overall limit for tax year 2025, which is $70,000, you would only have to pay yourself $70,000 of W-2 wages. And then you can contribute the entire $70,000 overall limit to the voluntary after-tax solo 401k bucket. And then you can wait until your business tax return due date in tax year 2026 to open the solo 401k plan so it's effective for 2025, and also make that voluntary after-tax solo 401k contribution in 2026 for 2025 by that S Corp tax return due date. And if you file an extension, you would have until September 16, or is this, let me see, it's either September 16 or September 15 of 2026. Let's look at our graph here. You would have until September 15 of 2026 to both open the solo 401k plan and make the voluntary after-tax solo 401k contribution for tax year 2025. So that's important to understand there. Looks like we have some more questions here. We'll take a look at those here in a moment. So why does the mega backdoor Roth's strategy matters? Why does it matter? Well, because it's an indirect way of getting more Roth money into your retirement account. Whether you convert it to the Roth Solo 401k or the Roth IRA, you can get tens of thousands of dollars in Roth funds utilizing the mega backdoor Roth Solo 401k strategy. Therefore, by converting it to the Roth IRA, the Roth Solo 401k, you're indirectly getting more Roth money into your retirement account. And also, the voluntary after-tax solo 401k contributions as part of the mega backdoor Roth strategy is not impacted by your earned income like Roth IRA contributions are. Of course, you have to have enough net self-employment income from your self-employed business in order to justify the contribution. In other words, you can't contribute more than you make, and you also can't contribute more than the overall limit for the year, which is $70,000 for tax year 2025. And we're anxiously waiting to see what they're going to be for tax year 2026, which the IRS should be releasing either this month or next month. And of course, with the mega backdoor Roth solo 401k strategy, when you convert those voluntary after-tax solo 401k contributions to the Roth solo 401k, you can borrow from that Roth solo 401k through a solo 401k participant loan, where you borrow from your own solo 401k, typically 50% of your total solo 401k balance, not to exceed $50,000, and then you pay back your own solo 401k. That type of strategy is not available in Roth IRAs or any type of IRA for that matter. And also, when you're making real estate investments, a lot of clients like to invest in rental properties through their Roth solo 401k. So utilizing the mega backdoor Roth is a way to get more Roth solo 401k money, which then you can utilize to invest in a rental property where the Roth solo 401k owns the property. All the rental income goes back to the Roth solo 401k, therefore growing tax-free. Also, if you utilize debt financing, known as a non-recourse loan, when investing in real estate through a Roth solo 401k, that's not going to trigger unrelated debt finance income tax, which does get triggered if you utilize the self-directed Roth IRA. So it's not as advantageous. Okay, let's see if we have some questions here. So, got a question here from Eddie. My understanding is that Roth IRA allows withdrawal of principal contributions without penalty, which I plan to fund via the Mega Backdoor. So we've actually recorded a live webinar on that topic. If you visit our YouTube channel where we have over 900 videos, you can access that webinar that we did. But keep in mind that the distribution rules, while similar between a Roth Solo 401k and a Roth IRA, they are slightly different. And I don't want to get too deep into it because, again, we probably spent over an hour just covering that topic. But at a high level, when you distribute funds from a Roth Solo 401k, you've got order rules that you have to follow. So, one, you have to first qualify to make the distribution. So when you distribute funds from a Roth Solo 401k, you've got two buckets. You've got qualified distributions versus non-qualified distributions. A qualified distribution is one where A, you've had that Roth Solo 401k for 5 years, and B, you are age 59 and a half or older. So you have to satisfy both of those requirements. Now, be careful for those who open a Roth Solo 401k and they're over age 59 and a half. So when you're over age 59 and a half and you open a Roth Solo 401k for the first time, well, you will immediately satisfy that first part, which is age 59 and a half. However, you're going to have that Roth Solo 401k for 5 years before you can distribute those Roth Solo 401k funds tax-free. So you have to be both age 59 and a half and have had that Roth Solo 401k for 5 years. So let's say you're 60 and open up that Roth Solo 401k. Well, you've met that first part of the rule, but you still have to wait 5 years. So till age 65 before you could distribute the Roth Solo 401k funds. And we're talking about the gains in that Roth Solo 401k. Now, if it's a non-qualified Roth Solo 401k distribution, you're going to have to take out some of the basis and some of the gains. You can't cherry pick like you can with the Roth IRA. But the Roth IRA, the order rules allow you to distribute the contributions first. And then after that, you can distribute amounts that were converted from the traditional IRA to the Roth IRA, as well as funds that were transferred from the voluntary after-tax solo 401k bucket and to the Roth IRA bucket. So in short, there are certain ordering rules that apply. So keep that in mind. Okay, and again, we did a detailed webinar on that topic. I could probably spend more, easily 30 minutes just talking about that. But I'll be on here all day long. We're already going on close to an hour, so we'll be finishing here soon. Okay, so it's like Eddie's got another question here. Let's see here. Am I restricted on the type of products I can trade Roth IRA? My broker will likely be Schwab. Specifically, will I be able to trade futures and Roth IRA fund the backdoor? Yeah, you can check with your financial advisor, but the Schwab Roth IRA, it's my understanding that you can trade options and futures. So double check with your advisor on that. All right, let's continue here with our webinar here. We're almost done here. So we've been talking about the year 2025 Mega Backdoor Roth setup deadline. So this slide here talks more about which strategy you want to utilize. In other words, do you want to make pre-tax solo 401k contributions so that you get a tax deduction in the year that you make the contribution? Or do you want to utilize the voluntary after-tax contribution, which you do not get a tax deduction for, but the trade-off is that you convert it to the Roth IRA or the Roth Solo 401k. Now you get tens of thousands of dollars in Roth funds, and those are going to grow tax-free. So you got to determine whether you want to save taxes now or later, because when you make pre-tax contributions to a solo 401k, you get a deduction in the year that you make the contribution, therefore reducing your taxable income for the year. However, later on when you distribute those funds, you're going to have to pay taxes on the contributions and all those earnings. Whereas with the mega backdoor Roth, you don't get a contribution up front, but when you convert it to the Roth IRA or the Roth Solo 401k, that's all going to grow tax free. And as long as there's qualified distributions, you won't have to pay any taxes. Okay, let's see here. So when you open a solo 401k with my solo 401k financial, again, the year 2025 mega backdoor Roth setup deadline is not till next year in 2026, but your tax return due date plus time you filed extension. But why procrastinate? It's probably best to open it by December 31st of this year so you don't forget to do it next year. So if you want to open a solo 401k, you would complete our online application. We draft the plan documents. We email you a download link. You sign the documents, upload. Then we help you to open up the solo 401k holding accounts, whether at your local bank or brokerage firm. Then we help you calculate contributions. In that case, the mega backdoor Roth calculation. So we'll help you open up the brokerage accounts, help you calculate the contribution. You then make that after-tax contribution. Then you convert it to the Roth Solo 401k or Roth IRA. We'll issue that Form 1099-R if you timely request it. We don't charge additional fees for that. Many of our competitors do, but we don't. We'll even file it with the IRS for you. Some competitors only prepare the form and they make you file the Form 1096 with the IRS. So we get the job done all the way and short. Let's see here. I think we're at the end of our session here. So again, thank you for joining today's daily webinar. We'll be live again here in a couple hours. Until next time, have a great rest of the day.